Hello folks, this is Michael Huddleston with the Pro Traders Club technical review for the pound versus US dollar for February 16th, 2011. Alright guys, we had an opportunity to see what I refer to as riding the lightning. Looks like, okay, that was London session last night. And let's go over the rundown on how it unfolded. First, we want to take our pivots and where it says show level 3, I'm going to put that to true. Okay, and what that'll do is actually throw up R3 and S3. So it'll give you the extended pivots. Alright, so we had R3 from the 15th, traded right up to it into London, Central European start. And right in here, it's probably hard to see here, but what do you see right there, guys? Optimal trade entry. Okay, before we get to that part, let's talk about this high here. Okay, this one's for Aaron since he's fallen in love with the turtle soup reversal pattern. Okay, and this is how it works. It's a very simple pattern to trade. We have a high. When price trades above that high, as we did in here, hit a resistance level. R3 from the 15th hadn't been touched. We traded up to it. Also, we have a R1 and central pivot. Okay, watch what happens here. Here's the 50% retracement level, converging within 15 pips of an old high, and also very close proximity to R3 from the 15th. Okay, let's take that fib out. We don't need it. Now it's basically illustrating the midpoint between central pivot and R1. So that would be MR1. And real quick, I was reviewing the video I made before this one, and I was calling the midpoints SM1, and I was very rushed to get through it because my son was trying to get my attention that day. I apologize, but this area here is MR1 mid pivot for R1 and central pivot. So we had a confluence of resistance levels in here, and we blew out this high here. So whenever the market trades above a previous high into a resistance level, we can expect it to try to trade back below this previous high. And once we do, it'll try to retest as it did in here and tank. The pattern itself is basically looking for a break or false break out higher, and then you sell right into a bullish candle as it hits the resistance level. Okay, so in other words, this candle here, you would have sold into the high. The high on this candle was 161.85. What level is that? 161.80 institutional level. Okay, so let's go down to a 5-minute chart so we can show how we can narrow down and zero in on a really low risk entry point. Alrighty, I'm going to take the fractals out just to add for clarity. Okay, we have a high. The price moved above previous day's high. Previous day's high here. traded above. Okay, then we started to slip down in here. We are going into the London trade, the opening, so we want to be looking for a high or low to be forming in the market. Since we are trading above previous day's high, we're looking for an opportunity for it to present a likely top. Okay, so here's our 62% retracement level right here, and then right here is our 79% retracement level. Optimal trade entry right in here. So on this candle, was your opportunity to get short. Now, I used 161.70 and 162 was my protective stop. I did not monkey around with the 5-minute chart to reduce the risk, but you could have done it with 20 pips or less in here very, very comfortably. You could have got actually a 10 pip risk in here, but that's for a different time, another day. 161.70 was the fill, and first profit objective obviously is always at 30 pips, and then we had a old low in here, so we'll use this line in, drop it right there. Market bounced here, broke through, traded back up to it, support broken becomes what? Resistance, guys. And we made a fractal high in here. That's where we slid down, rode the lightning down to S1. And this morning going into New York, it gave us a bear flag formation in here and broke down below S1, trading into a low for the North American session. Now, London close did not give us an opportunity for optimal trade entry, but it did bounce up in here, and then it tried to get down here to S1 and use support, but it just didn't get down to that level. We did trade up to central pivot a couple times in here. I am short presently at 161.05 on the pound. I'm just looking for a little scalp. I'm going to take profits, or hopefully if it gets down here 160.80, and then look for S1 retest. My stop is resting at 161.20, and I'm not suggesting anyone follow me on this trade. It's really not panned out as well as I was going to hope for, but if it does, that's great. But depending upon how it trades when it gets to 80, I may just take it all off there after my first limit gets off. But that was the trade for last night, and the announcement that came out this morning really drove the market down concerning interest rates. So that was kind of the catalyst behind it. But all this was the setup for what was already known by those in the smart money class, and they were selling it, and then all of a sudden it just got crushed. So very profitable trade. This level in here is what I used my exit, using the previous day's central pivot, and I did not catch anything in here, but again, I am short here with a scalp for hopefully a couple pips. But that's what we had for last night for the cable, and I gave you the trades on the blog, the one that was the long in here, that a few other traders were able to get a piece of, and that's pretty much it. It's been pretty wild actually for trading And if you've been beat up or if you've been sitting on your hands, don't be in a rush. You're not losing any money doing that. So just relax and wait for the setups to come. But basically, my point tonight was much like in the feedback section. You want to be looking for an opportunity to see a price swing, okay? And if you can get a optimal trade entry on top of a pattern, or if you get a nice price swing of at least 40 pips, run a fib on that and look for optimal entry on that. You want to see a lot of tools line up for the London session, and I'm going to speak in terms of New York time where I live. You want to be monitoring the time zone between 2 a.m. and 4 a.m. Your signal will come between those hours. On London close, we've already discussed that and the parameters around that. That's a window of opportunity you need to be looking at. Around 8:30 and 9:30, when the news embargo lifts in New York, that's an opportunity to be looking for a trade to form. And Asian session anywhere between 7 p.m. and 9 p.m. Eastern Standard Time, and you just got to convert that to your local time. And if you can monitor those time windows, opens and closes, sessions opens and closes, you will be able to find a trade, and you won't have to look very often, really. I mean, it's at least one of those sessions a day will give you something. So if London doesn't pan out well for you or you lose, New York, look for the London close or the 8:30 to 9:30 window where the news events will provide a swing in the market you can use. And if you miss that, use the Asian session later on. But just expect the Asian session to pay out very little. If you can get 20 pips out of the Asian session, consider it a windfall. Once in a while, it'll bless you with a nice swing, but for the most part, just look at 20 pips and be happy with it. And with that, guys, I wish you good luck and good trading. Hello, folks. This is ICT with the Pro Traders Club entry for February 16th, 2011. Okay, 636. I was very impressed by this guy. This was a good trade here. He had all of his key levels noted. Optimal trade entry around the institutional level and taking profit at an old low. Awesome, awesome, awesome. Railroad checks came in also at this area here and finally bounced up in here. Excellent trade. Yes, a SMT is basically overlaying any closely correlated pair. The euro versus the dollar and the pound versus the dollar are my favorites, but you can trade the euro yen and euro yen and pound yen because both of them have the same base cross currency being the yen. So they would be closely correlated, much like the fiber and cable. There are other ones, but those two are the primary ones that I track. And hello, goodbye. Well, you can't catch all of them, so just be thankful you got some profits there. It's good. Okay. This is a an illustration of the smart money tool, and basically it's an overlay of the pound versus the euro. And how this works is, this is for you, Shandy. So as the markets trade in tandem, being the euro and the cable, because they usually work very closely with one another in terms of direction. Not always, but when the majority of the moves are underway, they'll move in tandem. The key is you want to look for there's a crack in their correlation at some point in time, and it's like a footprint in the snow. And the commercial traders and the banks and institutional traders that move huge blocks of flows and large amounts of currencies, what they'll do is, because they are in the business for a real tangible reason instead of us like speculators, they have a real reason to be moving these currencies, and they have a better understanding of the fundamentals much more than we do as the small speculators. So it stands to reason, if these two pairs are closely correlated and they move, for instance, up in this instance here, as they are moving here, this pair made higher highs while this pair made lower lows. Now this could be an indication of a intermediate or a long-term high that's in the market forming. So in other words, this gives you an opportunity to prepare yourself for a short trade. Does it mean that it's going to happen right away? No, it just means you're setting yourself up for an area of resistance, in this example here, that may unfold into an intermediate term high or a long-term high. Now, behind the scenes and underlying dynamics of this suggests that they were selling more of the British pound than they were selling of the euro. Now they both moved down lower, but you're not trying to gauge which one you should short based on this. You can use it like that. I don't, but you can use it for relative strength. In other words, if you want to be selling the weakest and buying the strongest, that's just how you can use it. So, in instance, you would sell the pound here more than selling the euro. So, if you traded two pairs in your arsenal of forex pairs to be watching, I don't suggest you do that. But if you do want to trade two pairs and you want to be a deviant, not trade just one, trade two closely correlated pairs, and you can short the weaker one. In this case was the pound. Now you're really safe in certain aspects because they move in tandem. If you're right on your directional bias, even though the pound is the weakest here, and say you were wrong and you shorted the euro, you still would have a sympathy play, and that sympathy would spill over into your trade and it would try to follow suit going lower. In terms of a bullish market, when the currency pairs that are closely correlated trade lower and make a lower low, much like a mirror image of what this was here, simply because you see a divergence. Let me throw this in real quick. If you see a divergence between the two pairs on this overlay, you don't trade just simply on that. You want to refer to this just like any other indicator after you've already determined a key support and resistance level. If you don't have that noted or have that in mind before you go into looking for divergence on a smart money tool, it'll lull you, much like anything else by itself, into believing that there's a trade there. And this is a confirmation tool. It's not a selection tool. It can give you confirmation to your trade buys. It can give you confirmation to a support or resistance. In this case here, this really added weight to price possibly failing at a key resistance level. Also, if you're looking at the pound yen and euro yen, this tool absolutely helps in terms of confirming highs and lows, because you use a lot of whipsawing in those pairs because it's widespread, and market makers, they like to manipulate that a little bit more than they do the majors, and it's much more effective, and you see it happen more frequently with the euro yen and the pound yen, that it creates really sound divergence, bullish or bearish. So basically, in a nutshell, you're just looking for a key resistance level or support level on your at least a 5-minute chart. Yeah, you can get some pretty good swings with that one if you're a scalper. But I generally like to see a 15-minute or a 1 hour divergence, and you can get daily chart divergence between highs and lows also, and that just sets up the stage for confirming your position trades that last several days up to several weeks. All you have to do really is just overlay the two pairs and just study key support resistance levels and how these two signaled a confirmation, or when resistance may have looked like it was going to present a a restraint to prices moving higher. If the SMT did not diverge, a lot of times you'll see that it confirms the fact that don't be so aggressive. Maybe if you're going to sell that resistance, don't risk so much on the trade. Go about half or even a third of what you would risk normally. But if you do have a resistance level and all your tools are suggesting that it's a short, and you see something like this, by all means, this is when you can risk up to 2% for the trade. Okay. I hope that helps a little bit with your understanding. It really doesn't get any much more complicated than that. It's just a means of confirming a resistance or a support level, and it gives you like an X-ray view as to what the big dogs are playing in the market, if they're shorting or selling. So there you are, Shandy. I hope that has helped. Again, I'm getting from your post here, it says that you've never got this tool understood to the point where it gives you the indication, and I think that's the problem. You're looking at this first. Maybe I'm assuming that you're looking at this tool first in terms of directional bias, and it's a confirmation tool. It's not a selection tool. So in other words, you have to have a predetermined support resistance level. So again, I hope that that answers it for you. If not, get a little bit more specific on how I can answer it for you. But in the future, you'll see more examples of it being used. Yeah, basically it's how it's done. 636. Appreciate that. And Hordane was looking for my first form, and there's Sweet Pip. Yes, exactly. When it's making lower lows and the other doesn't follow suit, it is a divergence. Right. Very good. Well, this phrase right here, that's key in all of your trading. You're not going to get black and white. You're going to have shades of gray you have to work within. So just like any other tool by itself, it's useless. But when you blend it with at least 3 or 4 other things in your arsenal that give you a confluence, then it is very powerful. Moving along. Thank you, Cuban Pip, for sharing that link to the first my threads. Okay, I haven't looked at this. Um, I'll take a look at it before I comment on it. I don't want to take up any more time with it here, but if it does work, that'd be neat. Okay, if this is working, if it does do what it's being suggested by UK Dave here, um, absolutely no problem for me to grab it, and I'll share that on the first post as well as a resource. Again, I'll add that to the first post this weekend. I like that tool. I thought that was kind of neat. Very good, Ordain. That's an excellent short you took there. That's awesome. Whenever you see this ATR, um, if you hear me say average daily range or ADR, it's essentially the same thing. These two terms, ATR, average true range, and average daily range, they get tossed back and forth. And I may inadvertently use one or the other, but it's basically, for me, in my methods, I'm referring to what the average 5-day daily range in terms of pips is. And after we make a low, you take that low and you add the average daily range to it to get your projected high. And if we make a low in the London session, for example, I will take the average daily range and subtract it from the high, and that'll give me my projected low. I did get emails about that, so I just want to clarify that real quick. Awesome trade again. Actually, it's been a day trader's market, Ordain. It's been very difficult for myself even to determine where the directional bias is, because market flows shifting in and out, and it's been pretty crazy. So if you haven't been able to just simply go in and day trade the sessions, London, Asian, and New York, then position trading it, I think right now is scary, but certainly you can day trade it. Okay, again, say here we have the ADR, average daily range. Okay, getting stopped out, that's part of the game, guys. I mean, how you look for the next trade is how it's going to define you as a trader. So the best thing to do is, when you have a loss, just mark it up as a learning experience, but do not let it hinder your next trade, because like my first series of videos said, you have to forget the last trade, whether it be a profitable trade or a losing trade. Whatever that trade has done for you, once you're out, it can't do anything more for you. You can't lose any more money on it. You can't make any more money on it. You can't change the outcome, and you can't change your entry because it's past. So the best thing you can do is try to learn from your losses, but don't let them hinder your future trades. Don't let them give you trader paralysis. And if you're on a winning streak, don't let it go to your head and start leveraging more and risking more, because you've been on a streak. Because eventually what will happen is you'll start thinking, well, I'm risking 2% or less now, and if I would have done 5%, I could have made X amount of dollars. So I've been hot lately, so let's Risk 5% now, and that'll be the trade you lose on. And then what'll happen is you'll start a cycle of over trading, trying to get it back, feeling like you made a blunder, and you want to erase it and fix it by doing more trading, and that's just a mistake, and you'll hurt yourself doing that. Okay, Jourdain discovered the divergences. I was looking at this, and I wanted to bring out something else. See these lows here that were not met here? Okay, that in itself is an intermediate swing. Okay, you can't see it in here because he cut it off, but this is a lower low here. In other words, if you follow this line down, it made a lower low here. It was not seen here, and that called a low in the market, and it turned. Failure to swing high here, failed to go higher as this one did, and that was the intermediate term high. Here's the intermediate term high in here also, higher high here, lower low, lower high here, and that is your classic failure swing for a bear scenario. And then you see prices slip down. So yes, I believe you do have the concept. You just got to study it for a while, and you'll see a plethora of wonderful confirmations to resistance and support. All right. Again, I really wish I could pronounce this, but everybody can see it. So excellent, excellent, excellent trade. I love the clarity of your example here. Your chart is beautiful, very clean. It's very crisp. Everything you can, every level you can see, and all the analysis tools are superb, excellent. See this swing here, guys? Before you consider taking a trade, I'm going to toss this as a tip for tonight. Put this in your notebooks also. Whenever you're trading, whether it be the London session, the North American session, or the Asian session, the easiest way to trade with consistency and harvesting pips is you want to see a price swing of some sort. Okay, now the swing magnitude in terms of pips, the more pips it moves, the better the trade setup's going to be. Now you want to see, at least for a really high odds opportunity, you want to see at least a 40 pip swing. So if you get 40 pips, like from this low here to this high, now I know this is what's this, 10, 20, 30, 40, 50, 60, 70, 80, 90, so roughly 90 pips or thereabout. That's an awesome swing to run your fibs on. And then when you see optimal trade entry, okay, even if price fails to make a higher high in here like it did here, you have so much opportunity to get the pip range in profit from your entry to retesting this high in here, which is where you should always be trying to take some kind of profits at the fib high or low that you projected the swing from. And that's what you're looking for. So if you get at least 40 pips in here, 60% of that will give you at least 20 pips, to get profitable. So for those that are always looking for that 20 pip a day, that's one of the key ingredients for you to be able to do that. And if you get a session like the London session, if it gives you a swing of 40 pips or more and you can run a fib on, and you have your directional bias understood, it'll give you a very sound basis to find at least a 20 pip profitable trade, and then lock in some some future profits and move your stop up to break even and let it run hopefully for the London close. Again, that's if you're assuming the directional bias is going to continue through at least until 10 or 11 o'clock New York Standard Time, thereabouts when the London session closes. So again, if you're looking for like these tiny little moves in here, like this small little swing in here, running a fib on that, it's not as stacked in your favor in terms of odds. you want to see a directional move of some sort in at least 40 pips or more. That way when you run your fibs, 60% of that range is at least 20 pips, and you want to be able to take profit here and hold on, hopefully, for it to reach to the 127 or 162% extension as he has here. And very, very good. Excellent, excellent trade, guy. Yeah, this was, I'm going to like this right now while I'm here. This was very interesting when I read it. They say that it took the first London close trade and used optimal entry and using his notes. All the information here, excellent, very good. And very first London session closed trade, and it felt good, even though it was just a little diddly scalp. Well, these scalps, they add up, and if you continuously look for one setup, and this could be one setup that you trade, or every one of us that follow the market can do, and it's very consistent. You know, when it appears, it's very profitable. So kudos for that guy. Yeah, that was neat. I appreciate that. It's cool. I'm glad you're seeing the light. There we are, Shandy. Again, hopefully that answered your inquiry tonight. Very good. Very, very, very good. 100 pips, man. That's awesome. That is awesome. What I like most about this post is they're saying that refraining from taking any more trades for the week since he's hit 80 to 100 pips as a target. That's awesome. So kudos for that. I'm gonna like that as well. I am absolutely stoked that you guys are being able to use these tools, and it's been a benefit to you. Nothing thrills me more than to see that you know, my most precious collection of tools and concepts that I've been blessed with. I'm sharing with you, and it's awesome to see you guys doing as well as you are. It's great. Okay, Bach 11, you're on the same page as the other gentleman. I appreciate your thank yous, and this is excellent advice, because if you still are struggling, chances are, like I said before, the first couple videos, even though they are boring, that's really where the meat is, because it's not in all these little technical tools and wiggle waggles and pattern this and pattern that. If you don't have the mindset going into this, all these tools are just going to be at your disposal, but you'll grab them using the wrong mindset. You'll be rushing to do something when there's no time to be doing it. You just got to have the right mindset, and those first few videos are really aiming with that in mind. So I appreciate Bach's little nudge for those that may have been overlooking those videos. And if you do, if you go over them, it gives you the core essential traits of a successful trader, and some of the pitfalls that you will find yourself in if you haven't already as a new trader, and how to avoid them. They are avoidable, and the most amazing thing is they're all controlled by you, and you make the decisions to do the wrong thing. And if you don't understand it as a pitfall, you'll continuously do it, and you'll blow out demo accounts, you'll blow out your live accounts, and it'll be an endless cycle until you get to the point where you understand that you are the problem. It's not your system, it's not the market itself, because the market's going to do what it wants to do whether you're in it or not, and it's for your benefit to get your mindset in tune with how the dynamics of the market operate, and then hopefully when the odds are in your favor, you take advantage of that and see a profit and reduce risk and control risk all the while. So that is this installment for the thread and feedback section. And I will close this portion now, and we will move on to the technical review.